All right, good morning. Mike and Corey are here today. Steve is out, so we are filling in. Today's topics, we're going to talk about a Vibecession, a continuation of the cash trap, which Steve spoke about yesterday, and then S&P 2025 earnings projections and where are we going. But before I get started, I must remind everyone this is a financial education presentation. You must do your own due diligence on anything that you hear. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So let me share my screen. And so I know that Steve brought up this new term a few months ago called a Vibecession. And I was not an English major or an English guy, so I'm not real keen on making up words, although I know what stagflation is, but a Vibecession. So this came up, and it's kind of about this concern, like what's going on. So I wanted to hit a few things on this. There's a concern that inflation is rising. And there is always inflation. It's been a long time since we've been in a deflationary period, but inflation. So inflation is a little bit over 3%. The Fed wants to get that thing down to 2%. But I want to make sure everyone's aware that the prices are not going to go back to what they were 4 or 5 years ago. So I think it's like there may be a misconception that like, wow, if we really get inflation in control, like prices are going to go back. That's not going to happen. That just means inflation means it's just they're going up more slowly, but they're going to continue to go up. So, and where does that affect? I mean, that's anywhere from groceries. Now, you do see things with gas prices that go up and down. Home prices continue to be high, but you're not going to see the price of everything drop by 20 or 30%. Unless we are in a lot of trouble, that would be problematic. We actually don't want to see that. So let me continue on and kind of talk about this Vibecession. So the belief that inflation is too high, but Americans have seen their buying power or their wages go up is a good thing. Certainly it's good when your wages go up, but if prices are going up, it's kind of like, yeah, we're giving you a $20,000 pay raise, but your expenses are $25,000 higher. That's not really a good thing. It's just they go up together. So certainly a concern going into this fall and this election season. And I know this is going to be a topic at these upcoming debates, of which I think the first one is this Thursday. I did see a kind of good news here. Are we in a Vibecession? More than half, 55% of Americans are optimistic about their household finances. And I'm not exactly sure how they do that survey. Hopefully you're in the 55% and you're optimistic. We want to be positive where we're going. The market's always going to be up and down, and that's why I'll say that while we're looking at it every day and paying attention to it, hopefully you don't have to. I really don't want you to. Certainly you can. It's all public information, but it can be depressing to see drops and things going up and down and cause concerns. The other topic I want to hit, and Steve kind of touched on this yesterday, and this is, let's see if I can get this to come up. Maybe it disappeared. The cash trap. So right now, interest rates are high. So as Steve talked about yesterday, CDs at 5.4%, and ways to invest in treasuries over 5%, and that feels really good after 10 years of having, let's call it 0 to 1%. If you had it in a high yield savings account, I remember seeing like, oh, this savings account earns 0.1%. Like it was like it's not even hardly worth transferring in there and then paying tax on. But here's what the cash trap is. It can feel good to have that money in there. And when the Fed starts to lower the discount rate and this comes down, that's when the stock market's going to take off, or that's the expectation is the stock market will take off because there's less expensive money to borrow. And certainly it's based on your age and risk level where you should be, but this is the graph I wanted to show you, but this is assets in money market funds. And there's, over $6 trillion sitting in money markets. So these are these short-term, consider it, cash level investments. When the interest rates go down, that money is going to need to find a place to go, because most people aren't going to sit there at a very low interest rate. And that's part of the reason why the stock market takes off. So when do you go in? I mean, that's kind of the decision. And this paragraph I have highlighted says it. Deciding when and how to rebalance a portfolio is challenging, even for the pros. And it depends on age, savings, expected needs. But here's the key point. Staying on the sidelines risks missing out on years of potential gains. So if you feel like you're on the younger side, or you're not going to run out of money, and even you could even be in the early stages of retirement, sitting in cash has an opportunity cost when the market takes off. So even if you're like, hey, I'm happy making 4% and the market goes up 20, you can say, yep, I didn't go down at all. I didn't experience any volatility. And that is true, but there is an opportunity cost. And that is what is called the cash trap. So Steve touched on it a little bit yesterday. There's certainly a reason to be short-term and have a balanced portfolio. Even mine has some money in treasuries to have a balanced portfolio, earning good returns. But at some point when those returns go down, it gets tricky on when you move. So that's why you should consult with your financial advisor. So with that, we're moving forward into the future. We're going to go through this election season. We're waiting for interest rates to get cut, but Corey's going to take us into next year. So I'll turn it over to Corey.
Thanks, Mike. That is such an important thing to remember, that when you choose those kind of fixed interest tools, you're sacrificing, there's an opportunity cost there, missing out on those other tools that can give you some income and capital appreciation along the way. And sometimes I'll talk about that one another day. Can you see my screen here?
Yeah, yes, I can.
Okay, so here, this is just a 5-year. I just wanted to kind of look at, where is the market valued? Well, sometimes when you're at all-time highs, it can be a little scary, like, whoa, is this a bubble? Is something going up? Well, when you take a look at market valuations here, this is the price to earnings ratio of the S&P 500 over the last 5 years. So this is for every $1 of earnings from those S&P 500 companies. What are you, if you invest in the S&P 500, paying for that $1 of earnings? And right now you can see that you're paying a little above $25 for those $1 of earnings. We did see that bottom in late September 2022. Now, what you do notice that, so from 2020 to late 2022, this is called earnings, or this is called earnings compression, or price to earnings compression. So it's compressing what each dollar of earnings is worth. This coincides with the Fed aggressively hiking. Well, there's a inflation in here, and the Federal Reserve aggressively hiking rates. When they aggressively hike rates and the risk-free rate of money increases, each dollar of corporate earnings just isn't as valuable, because it does come with some risks that risk-free rate doesn't come with. But of course, it does bring you those benefits as well. From late September 2022, we have seen the price to earnings ratio expand. So they call that earnings expansion. And we have gotten up to a 27. And that number could be just off a little bit. Earnings are released all the time from companies, and it's kind of a moving target. But I just wanted to mention one last thing. So are we in a bubble? Well, no, but we are on a little bit of a higher end of valuation right now. But what's important to keep in mind is that S&P earnings are also increasing right now, and S&P earnings are expected to increase to about $280 total among those S&P 500 companies for 2025. So if we take where the S&P 500 is right now and we factor in that projected earnings for 2025, we're actually right down here around a 20. It could be, depending on where you look, you might get a 19, you might get a 21. But for if the market just fast forwarded to the end of 2025, we'd be right there at about a 20 price to earnings ratio for the whole market. Now, what does that mean? Well, that's not a bubble at all. And what it really means is, from now until the end of 2025, you could seek some continued capital appreciation out there if things play out as projected. So that's one thing to look for. And I hope that gives a little perspective of, looking ahead.
Yeah, yeah. It's good to look at this, kind of a fundamental analysis of earnings. It's very important. Obviously, companies when they come out with their earnings, we're watching certainly the ones that we hold in a major way. Nvidia, Apple, Amazon, all the big ones. I want to say you'll hear like 70% of companies will hit their earnings expectations. So, and then when they miss, they drop. So our goal is, we want these companies to hit their goals. We want the market to rise. That's the challenge of those CEOs managing it. So, anyways, looking forward to that, and hopefully we get more good news coming up. So, with that, we'll talk to y'all later. Bye.